Welcome to Newarkian Videos for independent reporting and commentary. Here's today's story. Jocelyn?
Hi, Jake. Today we have Francis, who will be diving into California's school finance, a complex but crucial topic that affects every student in our state. Francis.
Hi, Jocelyn. Let me address a common misconception first. Many people believe their property taxes directly fund their local schools, like they did before 1978. However, since Proposition 13, most California school funding is actually centralized at the state level. Your property taxes go to the state, which then redistributes funding through a formula, except for a handful of very wealthy basic aid districts that still receive enough local property taxes to exceed state funding levels. Since 2013, California has used the Local Control Funding Formula, or LCFF. This was a major reform that fundamentally changed how we fund schools. The concept is straightforward: provide base funding for every student, then add extra support for high-need students through supplemental and concentration grants. These additional funds support English learners, low-income students, and foster youth. Now, when we talk about school funding, we need to understand two major categories: restricted and unrestricted funds. Think of unrestricted funds as your general checking account. They can be used for core educational purposes, staff salaries, utilities, and basic operations. LCFF base grants fall into this category. Restricted funds, on the other hand, come with specific rules and requirements. These include federal funds for disadvantaged students, special education money, and targeted state grants. Districts can't simply move money between these categories. Each has its own purpose and accountability requirements.
Quick question. How does California determine how much money each district gets?
Great question. This brings us to a critical concept: average daily attendance, or ADA. Unlike some states that fund based on enrollment, California provides funding based on how many students actually attend school. Let's say a district has 1,000 enrolled students, but their average attendance is 950 students. They'll be funded for 950 ADA. This is why attendance is so crucial for district finances. Let's talk about the annual reporting cycle. Districts operate on a fiscal year from July 1st to June 30th. Throughout this cycle, there are several key reporting requirements. First, we have the adopted budget in July. This is our roadmap for the year ahead. Then we have first interim reporting in December and second interim in March. These checkpoints allow districts to adjust their projections based on actual enrollment, attendance, and any changes in state funding. Finally, we close the books with unaudited actuals in September. This brings us to multi-year forecasting, one of the most challenging aspects of school finance. Districts must project their finances 3 years into the future. This isn't just good practice, it's required by law. These projections consider multiple factors: enrollment trends. Are we growing or declining? This directly affects our ADA and funding. Salary and benefit costs, including step and column increases and negotiated raises. Program changes, new initiatives, or necessary reductions. State funding projections, including cost of living adjustments. When developing multi-year forecasts, public school districts must adopt a conservative yet realistic approach. Underestimating revenue and overestimating expenses is generally safer than the reverse. However, projections should not be excessively pessimistic, as overly dire forecasts can undermine planning and stakeholder confidence. The ultimate goal is to ensure fiscal solvency while prioritizing and maximizing educational opportunities for students. Understanding these financial mechanisms isn't just about numbers, it's about ensuring we can provide quality education sustainably. When districts make decisions about staffing, programs, or facilities, all these elements come into play. Strong financial management enables strong educational programs. By understanding these basics, LCFF, ADA, restricted versus unrestricted funds, the reporting cycle, and multi-year forecasting, we can better participate in discussions about school funding and ensure resources are used effectively for student success.
Thank you so much, Conrad. This is valuable information. And with that, we have come to the end of the presentation. Back to you, Jake.
Thanks for that story, Jocelyn. And thank you for watching. Please like and subscribe for more future videos.